You're welcome to my channel. In this video we are going to be talking about dissolution or winding up of a company, which is the last topic in business law 2 or company law. In Uganda, the life of a limited liability company starts with registration, which constitutes documents, and the end of a company is depicted by dissolution or winding up. Or liquidation. Liquidation is the process by which a company or any other type of corporation is brought to an end. In other words, a company ceases to exist as a corporate entity. That's what we call liquidation, the process of ending the life of the company. And the process of liquidation involves the appointment of a liquidator, and the liquidator is tasked with closing down or selling off the corporation's business and realizing all its assets. It should be noted that liquidation is a process that starts with winding up and ends with dissolution of a company. An example was seen in the case of Equity Bank. It follows that liquidation is a step to winding up. After a liquidator has sold off everything and paid everyone, if the company is still a going concern, then it will not go into winding up. A liquidator must be appointed whether it's voluntary or by court. Winding up must be published in the Gazette or the official government newspaper. Therefore, after the directors have decided to choose any means of winding up available to them, in our instant case, a receiver was appointed. And this mode of winding up is called voluntary winding up, as provided under Section 268 of the Companies Act of 2012. Let's look at the advantages of winding up. First is debt writing off or debt discharge. When the company is winding up, it will have to write off the debts of those people who are likely not to pay. Then execution or attachment of any kind is stopped, like they stop operating work. Then directors are not put on pressure during winding up because they already appointed a liquidator who is in charge of everything. And then quick recovery, then by the operation of Section 272 of the Companies Act, which allows the Insolvency Act to be used and the procedure thereunder. So there is quick recovery because if a company declares that it's insolvent, it cannot be demanded by its creditors because it's already insolvent, which means that it's unable to pay for its debts. Let's look at the modes of liquidation. There are 3 modes of liquidation, and the first one is voluntary liquidation, which is both by members and creditors according to Section 78 of the Insolvency Act. Then there is liquidation subject to supervision of court according to Section 87 of the Insolvency Act. And lastly, we have liquidation by court. This is according to Section 91 and 92 of the Insolvency Act. And it's mainly enforced by the creditors. After the company has appointed a liquidator as per Section 62 of the Insolvency Act, and the notice of appointment has been advertised, then liquidators come in. And that's how liquidation by court comes in also. Let's look at the duties of a liquidator. We say the liquidator is that person that is appointed to be in charge of winding up of the company. Duties of a liquidator. First, we have the duty to take reasonable steps necessary to realize the assets of the company. Then secondly, we have a duty to take custody and control of the company's assets, and this is according to Section 100 of the Insolvency Act. Then he has to register his interest in land and other assets belonging to the company, notwithstanding in interest. Another duty of a liquidator is the duty to keep company money separate from other money held by or under the control of the liquidator. If he has any other money that doesn't belong to the company, he's supposed to keep it separately from the company money. Then he also has a duty of keeping accounting books of the company in the accepted order and retain the accounts and records of the liquidation of the company for not less than 6 years after the liquidation ends. A liquidator also has a duty to allow those accounts and records to be inspected by any creditor or shareholder where the court orders. A liquidator also has a duty to call the creditors' meeting in case of insolvency, and this is according to Section 65 of the Insolvency Act. Insolvency is when a company is unable to pay its debts. And Section 65 of the Insolvency Act is to effect that a liquidator shall call a meeting for all the creditors and present a statement of the assets and liabilities of the company. And if he fails to do so, it will be an offense which attracts a fine. A liquidator also has a duty to call a general meeting at the end of the year, and this is according to Section 66 of the Insolvency Act. And this happens if liquidation of the company continues for more than 1 year. Then a liquidator is required to summon a general meeting at the end of the first year of the commencement of liquidation. A liquidator also has a duty of calling for a final meeting and dissolution under Section 67 of the Insolvency Act. This meeting has to be called by a notice put in the Gazette. A Gazette is an official government newspaper as per Section 67, Part 2 of the Insolvency Act, and it shall be published 30 days before the meeting. Then within 14 days after the meeting, the liquidator is obliged to send a copy of the account of that meeting to the Registrar of Companies and also make a return of the meeting and of its date to the registrar. And on expiry of 3 months from the date of registration of return, the company shall be taken to be dissolved. And those were the duties of a liquidator. Thanks for watching. Don't forget to subscribe, like, comment, share with your friends, and watch my next video. We shall be talking about the interim measures and options to winding up that protect the rights of creditors.